Hi there, this is Dave Kimmer with Churchill Mortgage. There's been a lot of recent changes regarding Fannie Mae and Freddie Mac, as well as FHA. And in this video, I would like to explain to you what those changes are and how they affect you. I'm going to go ahead and share my screen with you to show you those changes. So Fannie Mae and Freddie Mac increased their loan level pricing adjustments for loans delivered to them after May 1st, 2023. These changes increased the interest rate for most buyers. Now, it takes about 2 weeks to deliver a loan, and most loans are locked for 30 days. So for most people, these changes took effect around March 15th. And shortly after Fannie Mae made that announcement, FHA announced that they will be reducing their mortgage insurance premium for FHA case numbers endorsed on or after March 20th. So with conventional interest rates going up and FHA mortgage insurance premiums going down, many buyers will now benefit by switching from conventional financing to FHA financing. So here's the old LLPA, or what we call loan level pricing adjustment chart. So if your credit score is 740 or above, or was 740 or above, and you were putting 10% down, then your loan level pricing adjustment was 0.25%. With the new chart, if your credit score is between 740 and 759, and you're putting 10% down, then your loan level pricing adjustment is 0.75%. So the loan level pricing adjustment went up by 0.5%. Now, what that means to you specifically is that your interest rate would be 0.25% higher. Let me show you how this works with a few different examples. So if your credit score is between 720 and 759, and you're putting 15 to 19% down, then your interest rate would be 0.375% higher. If your credit score is between 720 and 759, and you're putting 10 to 14% down, then your interest rate would be 0.25% higher. And if your credit score is between 720 and 739, and you're putting 20 to 24% down, then your interest rate is 0.25% higher. And if your credit score is between 760 and 779, and you're putting 5 to 14% down, then your interest rate is 0.125% higher. So here's the bottom line. On the average, if you have good credit, then your interest rate is going up about 0.25% as a result of these recent changes. Now that's $95 a month with a $600,000 purchase price and 5% down. In full disclosure, you do have the option of paying more money at closing to get the same interest rate as before. So in this example, it's a $600,000 purchase price with 10% down, $540,000 loan. So if your credit score is 720 to 759 and you're putting 15 to 19% down, then you could choose to pay $4,050 at closing extra to get the same interest rate as before the changes. Or if your credit score is 720 to 759 and you're putting 10 to 14% down, or if your credit score is 720 to 739 and you're putting 20 to 24% down, then you could choose to pay an additional $2,700 at closing to get the same interest rate as before the changes. Here's my question. Why would you pay $2,700 more at closing to save $95 a month on a loan that you expect to refinance in 12 months or less? Food for thought. Now let's talk about the recent changes to FHA. If your loan to value is greater than 95%, or in other words, if you're bringing in less than 5% to closing, then the mortgage insurance premium went down from 0.85% to 0.55%. And if you were putting more than 5% or more down, then the mortgage insurance premium went from 0.80 to 0.50%. Now that's a 35% reduction in that mortgage insurance premium. Let me tell you what that means to you. So that is a savings of $237 a month for a purchase price of $600,000 with 5% down. I'm going to show you some examples and scenarios. And in all of these scenarios, the purchase price is $600,000. And we're also assuming that we are negotiating a 3% seller concession. And we're using that seller concession to permanently buy down the interest rate. We believe this is the most effective strategy in today's high interest rate environment. And I've created a separate video discussing that strategy. So if your credit score is between 740 and 759 and you're putting 10% down, then you save $70 a month by switching from conventional to FHA. If your credit score is between 700 and 719 and you're putting 10% down, you save $204 a month by switching to FHA. If your credit score is between 740 and 759 and you're putting 5% down, you save $122 a month by switching to FHA. If your credit score is between 700 and 719 and you're putting 5% down, you save $230 a month by switching to FHA. So in summary, Fannie Mae and Freddie Mac recently increased their loan level pricing adjustments, which increased the interest rate for most buyers by about 0.25% or 0.25%. And at about the same time, FHA reduced their mortgage insurance premium by 0.35%. So if your credit score is less than 780, and if you're putting less than 20% down, then you'll probably save money by switching from conventional to FHA. If you have any questions about this video, please reach out to me. My email address is david.kimmer@churchillmortgage.com. And I want to thank you for watching this video.